name is Elle and I'm a senior investigator at the Commission in the credit branch. So in this short session, I will be talking to you about suitability assessment and informed decisions, which, as you know, are two important components of the lender responsibility principles. So much of what I'll be covering today is what we spoke to lenders about at the lender seminars earlier this month. So the way that this session will be structured, we'll be looking at suitability assessment first, then we'll move on to informed decisions, and then we'll look at both components in the context of online lending. So starting with suitability assessments and a bit of theory from the Act. So Section 9C of the CCCFA says that lenders must make reasonable inquiries before agreeing to lend to a borrower to be satisfied that it is likely that the credit or finance provided under the agreement will meet the borrower's requirements and objectives. So what does that all mean? It means that the loan or lending must be suitable and meet the borrower's needs. So suitability is about lenders making sure that they understand what the loan is for in order to provide a suitable finance product. It's not about the lender making a decision about how that person chooses to spend the borrowed money or the price that they are paying. So since the 1st of December 2021, the CCCFA has introduced a few additional obligations on lenders when making inquiries as part of their suitability assessment. And you're probably already familiar with these new obligations, but we'll go through them one by one. So the first one is that, as well as making the suitability inquiries before entering into a loan, lenders need to make the same inquiries before making a material change to an existing loan. The second one is that lenders need to take specific steps set out in the CCCFA regulations in order to satisfy the requirement to make those reasonable inquiries. And the third new obligation is that lenders are now required to keep records of the inquiries, but also the outcome of the inquiries. So we're not going to be talking about record keeping obligations now, as my colleague Luke will talk to you about 9C request later on this afternoon. So the Responsible Lending Code has been revised and includes additional guidance on how lenders can comply with the new requirements. And Chapter 4 of the code is the chapter that deals specifically with inquiries into and assessment of borrowers' requirements and objectives. Now, it's important to bear in mind that the code is not binding on lenders, so it means that they don't have to follow it. But the Act says that evidence of compliance with the code will be treated as evidence of compliance with the principles. So now looking at the new process for suitability assessment and the different method and extent of inquiries. So since the 1st of December 2021, lenders are required to follow the specific steps set out in the CCCFA regulations when making the suitability assessments required under the CCCFA. A failure to comply with the regulations will be treated as a breach of the relevant lender responsibility principles. So when assessing whether a loan is likely to be suitable, Regulation 4AA mandates that lenders need to gather certain information from the borrower. And this information can be summarized into 4 key questions. So the first question is, what do they plan to use the money for? The second question is, how much money do they need? The third question, how long they would like to take to pay it off? And the fourth question is how they would like to pay it off. Is it one lump sum payment or regular installments? So once they've gathered the information, lenders will need to assess it and decide whether the credit product is likely to be appropriate for the borrower. So let's look at an example. Let's say that a borrower wants to pay off the loan in regular installments, but have the possibility to draw down further advances. Then a fixed loan is likely not suitable in the circumstances, and lenders should instead consider discussing the option of a revolving credit product with the borrower. Now, the inquiries that are specified in the regulations are not a complete list. So depending on the circumstances, it may be reasonable for lenders to make inquiries into other matters. Let's look at another example. Let's say that someone goes to a retail store to buy an item that they want to pay off over a certain time frame. And the only way to do that is to sign up to a store card with a credit limit. So the rules around testing for suitability will apply. Now, because the regulations require the lender to ask the borrower what they need the money for, how much money they need, how long for, and how they would like to pay it off, the finance arrangement that the lender might provide needs to be able to meet those needs. So if the borrower only wants to purchase that one item, and let's say that it's $2,000, then that is the credit limit on the store card. If the customer is given a card with a credit limit of $5,000, then the extra unsolicited $3,000 may be unsuitable. So in order to determine the borrower's requirements and objectives, lenders may need to make a series of inquiries, including asking the borrower about their requirements and objectives, discussing available products with the borrower, working with the borrower to refine the requirements and objectives, and finally, confirming that the product is likely to meet the borrower's requirements and objectives as refined with the borrower and understood by lenders. So the code says that the scope and method of the inquiries that are reasonable for lenders to make may differ depending on the circumstances. Lenders should make more extensive inquiries where there is a greater risk that the agreement will not meet the borrower's requirements and objectives. And that can be in circumstances where the agreement is quite complex or uncommon, such as a buyback transaction or a reverse equity mortgage, or the agreement is a high-cost credit agreement, or the borrower is vulnerable. It can also be in situations where the information that lenders have received about the borrower's requirements and objectives is either inconsistent or contradicts other information provided by the borrower, or the information is unrealistic, or lenders have other reasonable grounds to suspect that the information is not reliable. Now, section 4.10 of the code says that lenders should also undertake further inquiries if the potential further inquiries are reasonably practicable and if the information is material to the suitability assessment. Now, the code says that in some other circumstances, lenders may undertake less extensive inquiries, obviously subject to being compliant with the regulations, but that can be in circumstances where the agreement is a simple credit agreement that is widely understood, for example, an overdraft, or the borrower is a well-informed user of credit. Now, it can happen that lenders identify an apparent conflict between the borrower's requirements for a loan and their end objectives. So, for example, a borrower entering into a home loan specifies that they want certainty as to the payments for a period. So that might require a fixed interest rate loan. But the borrower also wants flexibility to pay in lump sum amounts, which would require a different product, like a floating interest rate loan. So section 4.7 of the code says that where there is an apparent conflict between the requirements and objectives specified by the borrower, lenders should make inquiries to understand which of the conflicting requirements and objectives are the borrower's highest priority. For example, by asking the borrower to choose. And then lender can take this as the borrower's requirement or objective. So lenders do not need to canvass every single option open to a borrower, but it is expected that they will make reasonable inquiries of the borrower to understand the nature and purpose of the proposed credit. If the inquiry process is robust and thorough, the information gathered should lead lenders to a discussion with the borrowers about all the credit products they have available that satisfy the borrower's needs. So now looking at the second part of this presentation, which focuses on assisting borrowers and guarantors to make an informed decision prior to entering into a consumer credit contract, but also in all subsequent dealings. And again, a bit of theory from the Act in Section 9C that says that lenders have the obligation to assist borrowers to reach an informed decision about whether to enter into or vary an agreement, and to be reasonably aware of the full implications of entering into or varying the agreement. So this includes by ensuring that the terms of the agreement and any variation are expressed in plain language in a clear, concise, and intelligible manner. That any information lenders provide to the borrower is not presented in a manner that is or is likely to be misleading, deceptive, or confusing. And that lenders have taken reasonable steps to offer the borrower information about the agreement in another language. Now, it's important to remember that this principle also affects how lenders can advertise, as they must ensure that all advertising and information provided to the borrower and guarantor is not likely to be misleading, deceptive, or confusing. So we're not going to be talking about advertising requirements today, but there is information on this on our website. Now, as I said earlier, let's now look at suitability assessment and informed decisions in the context of an online lending environment. So it's important to remember that regardless of how a loan is made, whether it is online, in person, on the phone, by text message, or by email, the lender responsibility principles apply. So we appreciate that more and more lenders are carrying out the lending processes entirely online and have no face-to-face interactions or even conversations with the borrowers at any point. And this is especially true if lenders are using agents such as brokers or car dealers. So that means that the processes and documentation that these lenders might use to make a lending decision are likely to be different from those that lenders would use if they were able to talk to the borrower in person. At the lenders seminars, we reminded lenders that the less contact they have with the borrower, the more steps or questions they may need to build into the online process to ensure that they have the right information to reach a responsible decision. It is also worth pointing out that the online agent approach has higher risks for lenders, as they may be relying on system automation or a third party to gather the information and documents that they will rely on to make a lending decision. But despite all this, even when third parties are involved, lenders are still ultimately responsible. And so what happens if lenders breach the lender responsibility principles? If lenders breach the principles, there can be serious consequences in the way of statutory damages and civil penalties, such as penalties up to $600,000, which can be imposed by a court. Dispute resolution scheme can also order the lender to pay the statutory damages, which are equal to the cost of borrowing. It's also important to remember that any breach of the lender responsibility principles might affect a lender's fit and proper certification with the Commission, as we might have to review and possibly amend the certification status. So just to conclude this short session, if you are working with clients where you may think the lender has not provided a suitable financial arrangement or might have failed to assist the clients to be aware of the full implications of an agreement, then you can ask the lender at what point in the loan application process did they do this. If that didn't happen, then you can certainly take that up with the lender and potentially with the dispute resolution scheme. Also, be sure to notify the Commission about it. So I hope you found this session useful. Paul, right back to you.